Okay. Hi, Wade. How are you?
Doing well. How about yourself?
Doing great. Thank you. Thank you for coming on the show. Nice to have you here. I'm curious about one thing, though. We don't usually get the financial guys on this show. How did you find us?
Well, there's the amazing, expansive internet that landed us to the Douglas Coleman show. So it was actually my assistant that discovered you.
Okay. All right. Well, we're happy to have you here. First off, you've got a company called Sidoxia, and you are the president and founder. Is that correct?
That's correct. Yeah, Sidoxia Capital Management was my investment firm that I founded roughly 15 years ago.
Oh, okay. You've been around for a while. What does Sidoxia mean?
Sidoxia is derived from the Greek word asiodoxia, which is Greek for optimism. So I've been investing for over 30 years, and there's a lot of bearishness or pessimism out there. But equity managers are people that invest in the stock market or investing in general. I tend to look at the glass as half full, and that's where I came up with Sidoxia.
So you've been in this business for over 30 years, you said?
That's correct. Yeah, I went to undergraduate at UCLA. I got my economics degree there. I kind of cut my teeth working for some different investment brokers, investment banks, and then I got my MBA or master's degree at Cornell University, and then I've been investing all along the whole 30 years, starting from college until now.
Well, I'm thinking back 30 years ago, online investing would have been in its infancy for the average consumer. Do you think that's helped or hurt the market with all of these new people sort of coming in, playing around in there?
Yeah, I think in general, it's been a huge benefit for individuals. If you go back 30, 40 years, you would have to phone in your order for a stock. And, the cost of executing that trade would be upwards of, 100 or $200. As you probably know today, everything's free. And even the costs for a lot of these funds have even gone free. So, in not to get off too far in the weeds, but there's this thing called the bid ask spread. And this is kind of how middlemen make their money by buying and selling. And that spread has tightened dramatically, which again is a benefit. So, yes, there are algorithmic traders and computers and things like that that'll try to quote unquote scalp or take advantage of individual investors where they're trying to shave off pennies or fraction of pennies. And, there can be a little manipulation around the edges. But for long-term investors, it really doesn't matter if you save a penny, a nickel, or a dime if you're really looking to invest for the long run. So the long story short is a lot of the technological advances have been huge benefits for democratizing investing for the masses.
Do you think it's caused an increase in volatility, in market volatility, because of all of that?
Actually, I don't.
Okay.
So you can go back to 1929 with the great crash, or you can go back to 1987 with a big crash there. This was all before you had computers trading automatically. Sure, we had the great financial crisis in 2008, and that was a lot of volatility, but that really didn't have much to do with computers. That was more about the mortgage and housing market and banks and financial institutions taking on too much risk, which is kind of the story for a lot of stock market volatility that we've seen, over generations.
Right now, the stock market seems to be very high. Would this be a time for somebody to get in, or would you wait?
Yeah, well, I've been listening to that for the last 30 years, and that is a question we get quite a bit. And The fact of the matter is that the stock market is a lot like real estate. It's very cyclical, goes up and down. But over the long run, it goes up, whether you're talking about the house or the stock market. And so, your question about the stock market could be applied to the housing market. Housing prices seem high. It is now the time to get in. And the reality there, it's a very open question, because there's a lot of different ways to answer. But the main measurement tool that people use, professionals, is the PE ratio. It's kind of the price to earnings ratio. And if you look at the price earnings ratio of the stock market overall, and most people talk about the S&P 500, and it's kind of the largest 500 stocks. And it's been an unusual market over the last year or so. Some of your listeners may have heard of the Magnificent Seven. These are the 7 largest companies, including names like Amazon, Apple, Tesla, Google, Alphabet. There's been really skewed. So the stock market last year was up about 24%, but most of the performance came from these top 7 stocks. If you looked at the other 493, I call it the absentee 493, the prices and the valuations are actually very reasonable historically. So yes, I am a little bit cautious about the stock market being a little pricey in these top 7 stocks, but we invest broadly across a whole universe of thousands of stocks, and we're finding tremendous value in a lot of those other areas.
What is the more common mistakes that the new stock market trader makes when getting into this?
It's a good question. I mean, I'd say the most common mistake that people make if they're new to investing is they are too short-term oriented. They're focused on what's the headlines, what people are talking about on the news, rather than looking for the long run. So the way we like to describe it is we invest with a telescope. So we're looking over the horizon into the distance, whereas most inexperienced or new investors are using microscope. If you just go back to COVID, there was an explosion of investing. These accounts are free. We talked about the trading costs are free. It's very easy, and it kind of turns into a casino where people were stuck at home, nothing to do, couldn't watch sports, and they traded a lot. And just like we saw in the tech bubble of 2000, a lot of people lost money. They got discouraged, and so that I think is the largest mistake people make, is they invest for the short term rather than the long term.
What do you consider long term?
Yeah, I consider long term measuring in years rather than days, weeks, or months. If you think about the average person saving for retirement, your prime earnings years are going to be in your 30s, 40s, and 50s. And really, the best way to generate wealth over the long term is to benefit from that power of compounding, that snowball effect. So it's not trying to, or the time in the market. It's not timing the market, it's the time in the market. So you can benefit from, the seventh wonder of the world, that compounding that Einstein talked about.
Okay, well, that's good advice. What do you think about crypto?
Yeah, that's another hot topic. Just because, again, people are looking for the get rich scheme. And so had you invested in Bitcoin, for example, there are literally hundreds of these cryptocurrencies. And I would categorize the vast majority as very speculative. And even Bitcoin, if you look at its history, you could have made a fortune had you invested as early as 5 years ago. But it's extremely volatile. It went up to 60,000. It collapsed to 16,000, and now we're trading around 45,000. But if you poll people, just friends and family or people around the water cooler, I just ask people, how many people are investing in cryptocurrency? You might get, 5 or 10%, but out of that 5 or 10%, when you ask them, how many of you actually transact? Are you using any of those things? And that's when you hear the crickets. You don't hear people really using the technology. It's really done for speculative reasons. There's a lot of criminal activity and scams that are used kind of in the dark web with these cryptocurrencies. So long story short, I'm a very much a skeptic of these cryptocurrencies.
We've got just about 3 minutes, so I want to hit a couple of your books. You've got 2 books out, is that correct?
That's correct.
Okay, How I Managed 20 Billion by Age 32 and 1001 Truths About Investing. The first one, is that sort of a biography of you?
Yeah, for the most part. So I'm 53 now, I'm going to be 54 next month. And I landed into a position at American Century, and I kind of climbed the ladder to the point where I was managing their flagship $20 billion fund, the Ultra Fund. And, I kind of describe managing it like a super tanker. It takes a lot of time to kind of move the ship around when you're investing billions of dollars. It takes a lot of time. There's a lot of price movement and indirect impacts you have on the market. Whereas now at Sidoxia, I manage over 100 million. It's more like taking a speedboat where you can get in and out. The costs of trading, there's a lot less impact. So yeah, in my first book, I talk about my investing philosophy, my experiences of rubbing shoulders with some of the executives from the CEOs from some of the largest companies like Jeff Bezos at Amazon or Lee Scott at Walmart, and just kind of talk about how I view things. So it's a great for my clients and prospective clients or people that just want to learn about investing.
And the 1001 Truths, we don't have enough time to go through all 1001, but give us one.
Oh, well, I think we talked about one of the truths when we talked about what investing you do. But I think one thing to talk about, another mistake tangentially related to what we're talking about is how people really get involved with what's in the news. And there's a great quote from Mark Twain who says, if you don't read the newspaper, you're uninformed. If you do read the newspaper, you're misinformed. And so the point being is that a lot of these headlines that you're reading don't have anything to do with what you're going to do for retirement, your standard of living, and it's more important to get in the habit and practice of saving and investing and ignoring these headlines, which in the grand scheme of things is just noise.
Well, Wade, on that, we're going to have to wind this down. Thank you so much for coming on. The last question, do you have a website that you want to give out?
Sure. You can just go to the name of my company, Sidoxia.com. So it's S as in Sam, ID as in David, OXIA.com.
Okay. And if somebody is interested in investing with you, they can go through there as well? Contact page?
Sure. Yeah. Just go to the website. You can give us a call or send us a note, and we'll follow up.
Okay, great. Well, thank you for coming on the show. This was informative, and best of luck with your work.
Thanks, Doug. It's my pleasure.